and development standards is morally bankrupt. However, to invest targeting impact without providing a strong return is not sustainable. As a community, as an investment community, we need to deliver returns as well as impact. Otherwise, we will have what we call one fund wonders. One fund, high impact, insufficient returns, no fund two. In order to really catalyze capital into the sector, into the financial inclusion sector, into the broader impact investing sector, we need capital from private sources. We need capital from pension funds. We need capital from insurers, other stakeholders. And in order to do that, we need returns as well as impact. If you look at the size of the global capital market, I think this really emphasizes why returns are key. So the global stock market is over $100 trillion. Global private capital funds is about $20 trillion. If we look at the amount of capital we've mobilized into Africa in things such as Africa private equity, or you look at the amount of African pension funds, and you look at that on the same scale, they're tiny specks. However, Africa is 1 billion people. Africa is nearly 1/8 of the world's population. If we're going to transform Africa into an upper middle income society, we're going to build it into a high income society like we enjoy in the West, we will need to mobilize capital from these global capital sources on the left hand side of the page, and these specs aren't sufficient. This slide just looks at the market excluding global stock markets, excluding global private capital. And you can see here, even on this larger scale graph, Africa private equity, 6 billion is tiny. It's a tiny proportion. It's less than 1% of the capital in Africa pension funds. It's tiny if you compare it to global impact funds. Yes, there's a lot of discussion about what is and what isn't actually an impact fund. There's a lot of greenwashing on that side as well. But if we can create sustainable returns, proven returns, predictable returns as a community, we can access and mobilize much more larger capital sources than we have available today. Development impact. What do we mean by development impact? Well, speaking for ourselves at Verdant Capital Hybrid Fund, our first and key development goal is decent work and decent economic growth. And most people in the room know that's number 8. They know that as number 8. But why is that so important to us? So if myself and my partner, we both have jobs, or we both have a sustainable self-employed income, we can buy food for our whole family, SDG 2. We can send our children to school, SDG 4. We can send all our children to school. In Africa, there's sometimes a culture that if there's not enough money, the boys go to school and the girls miss out. So we can send all our children to school. That's number 5. We can afford clean water. We can afford a solar panel. That's SDGs number 6 and 7. So we call that at Verdant, we call that the impact multiplier effect. But for us, that all starts with number 8, decent work and decent economic opportunities, UN SDG, UN Sustainable Goal, UN Sustainable Development Goal number 8. One goal that's not a UN Sustainable Development Goal is financial inclusion. So should financial inclusion be a sustainable development goal? Should financial inclusion be a human right? So we think it should be. And ask the question to the audience, what's more important, access to financial services or access to clean water? So wasn't really going to ask the audience. Most people say, well, actually clean water, because without water you die. And without financial services you don't die. Well, not right away anyway. So, But that's being slightly flippant. So financial services, I think everybody in this room is used to have a bank account or mobile wallet or some safe and secure store of value. We're used to be able to making payments electronically. So we don't have to walk to DSTV or walk to the utility company to pay cash to pay our bills. We can pay that electronically. Life would be very, very difficult if we had to pay everything in cash. We can send money to people, our kids, our parents, electronically. We've got credit for our businesses. We've got credit if there's a problem in our lives. We have insurance. If one of us is sick, we can get medical treatment without raiding that cash underneath the mattress. And we have pensions. So we have access to financial services. We know what life is like with access to all these financial services. We don't know what life is like without those. So what would you prefer? Would you prefer to have no financial services and running water in your home? Or would you prefer to have financial services and running water 10 meters from your house? Would you prefer access to financial services and have running water a kilometer from your house? Where's the break-even point? Is it 100 meters? Is it a kilometer? Is it 5 kilometers? But there is a break-even point. And to my point, financial inclusion should be one of the UN Sustainable Goals. Can financial inclusion be sexy? Well, yes, it can be sexy. You need to give it a new name. So in 2019, 2018, there was a new name for financial inclusion. It was called FinTech. And if you look at the amount of money that's been mobilized for FinTech in 2020, 2021, 2022, $2.5 billion was invested in Africa in FinTech opportunities. If you look at the amount of money that's invested today in microfinance institutions from the microfinance community, MIBs, DFIs, is about $500 million. Yes, there's issues of definition and drawing lines here. So FinTech has mobilized capital to drive financial inclusion in Africa. And we see the benefit of that today. But not all of the fruits of that FinTech boom will survive. Or put it differently, not all of that $2.5 billion was invested wisely. However, the fundamentals are true. We have a big addressable market. We have 700 million people in Africa who do not have a bank account, who do not have traditional financial services. We do not have entrenched, established operators who are serving that community. So yes, you can enter this market as an entrepreneur, as a new entrant, and you can build a brand, you can build a customer base, you can build a technology, you can build regulatory relationships. Ultimately, this is all driven by fundamental technology change, which is quite profound. So these are the 3 building blocks. These are 3 facts which would tell you that investing in this sector is profitable, should be profitable, and this is not a conflict with impact. This is an opportunity which drives both impact and commercial returns. And those 2 things should go together. Many people in the room have seen the slides in terms of some of the materials relating to Verdant Capital Hybrid Fund. But digital payments, much cheaper than handling cash. Loan life cycle that's fully digitalized, not paper-based. Proper credit scoring, risk-based pricing. All of this is done up in the cloud. We have specific loan products around tracking assets and around closed-loop working capital financing. So if you take advantage of what's available in the ecosystem today, not only should you be profitable, but the best operators are highly profitable. If you look at the portfolio in Verdant Capital Hybrid Fund, it's all very, very profitable. I think I'm being told to hurry up a little bit, which is fine. Here we go. Very, very quickly, we're targeting alpha, not beta. So I've been doing this business in Africa, private capital, for 15 years, 16 years. I've seen three cycles. Africa the markets here are thin, they're shallow. That means equity investing is subject to highly cyclical valuation swings. It's subject to liquidity traps. and I call that beta. So mezzanine investing, like Verdant Capital Hybrid Fund, we're there to capture alpha. We're there to pick the best management teams. We're there to pick the best business models and support them. And we're not riding these very, very volatile cycles. Okay. This is our fund. We've deployed a very good portfolio so far, $23 million deployed, looking to wrap things up next year with $100 million final close. Credit-enhanced junior debt, we're doing true mezzanine or senior equity, and we're investing in best-in-class micro and SME lenders, and we're supporting businesses who are arisen in this new era in the last 10, 15 years, as well as businesses transforming. And we're looking to promote job creation, livelihood creation, the trickle-down effect in terms of the impact trickle-down effect. And we're looking to build a robust, profitable, economically sustainable financial inclusion ecosystem which can mobilize and harness risk capital from around the world and do that as peers. We should, raising capital for financial inclusion in Africa, we should do that as peers to other asset classes around the world, offering both returns and impact. I don't know if there's any questions from the audience. Any comments? It looks like everybody's in agreement. The subscription forms are at the booth. Thank you very much indeed. Thank you for making time for the first panel of the day.